Hi, my name is Lauren Templeton, and you are listening to Investing the Templeton Way. This podcast is for anyone interested in learning more about investing. In this podcast, I will be interviewing some of the greatest minds from the investment community and exploring topics ranging from international markets to behavioral finance. To learn more, please visit us at investingthetempletonway.com. The information presented in this podcast or available on the website is not intended as and shall not be construed as financial advice. This podcast is produced for entertainment value. Investing is inherently risky, and I encourage you to seek financial advice from a professional who is aware of the facts and circumstances of your individual situation. Thanks for listening. Hi, and welcome to the Investing the Templeton Way podcast. I'm your host, Lauren Templeton.
And I'm your co-host, Scott Phillips.
We have a great guest for you today. His name is Nick Martin, and he's joining us from London. He is portfolio manager at Polar Capital Global Insurance Strategy. Welcome, Nick.
Thanks for having me. Delighted to be here.
Yes, and Nick joins us from the UK. He's in London. And as evident by the name, Polar Capital Global Insurance Strategy, Nick is a specialist in insurance businesses. So to kick things off today, Nick, please tell our listeners a bit more about your background and what attracted you to specialize in the insurance industry.
Yeah, thanks, Lauren. So yeah, I think I've always been interested in investing from quite a young age. I think probably the first real experience I had of the markets and stock prices was probably in an economics class during school, and there was a competition, I think, where you had to try and pick a stock or two and then see how they did over the next few weeks. Of course, that's probably the worst thing you could do to introduce people to the markets in short term, casino, get rich quick, all that stuff that obviously is not the thing to be thinking about, but certainly whetted my appetite for the markets, and I sort of took it up a little bit into my university degree. So I was reading a few things here and there, some investment magazines that are probably skewed to retail investors, full of stock tips, and I actually ended up using, I probably shouldn't admit this, but using a bit of my student loan to actually invest in the markets. And lucky for me, that was during the dot-com boom, so it was more luck than anything else that I did okay. So I still wasn't derailed on my sort of stock career.
That's
so
great.
After that university, I was training as a chartered accountant. It takes 3 years to get that qualification, and after 2.5 of those years, I picked up a copy of the FT, and that's back in the day when you used to have physical copies of newspapers, and saw in the recruitment section a job for a Lloyd's of London centric insurer called Hiscox, and the job that was advertised was to work with their group investment officer Alec Foster on his investment team, and that job had two real aspects. One was to look after Hiscox's money, and for a property casualty company, that's largely assets that are outsourced to third-party fund managers, cash, short-dated bonds, so not too exciting. And then the other part of the job was actually to help Alec work on the Hiscox insurance portfolio. So that's the insurance strategy that you mentioned at the start. So that was actually started in 1998, and I joined Alec in 2001. I was quite fortunate to do so. He wanted someone with over 5 years experience in the investment markets and in insurance, and I audited a few insurance companies up to that point, and as I just said, punted around in the stock markets for a couple of years, so certainly was nowhere near qualified. But luckily for me, Alec took a chance on a very enthusiastic 24-year-old at the time, despite the fact during my interview I repeatedly talked about this wonderful investor called Warren Buffett, and did that multiple times.
That's awesome.
Well, just at that kind of age, it's not the sort of thing you're discussing with your friends and family. So about Berkshire Hathaway and the like. So Alec overlooked that thing, and actually, I think a mutual friend of ours, Tom Gaynor, the CEO of Markel, did something very, very similar in his early days as a security analyst. So, I think he did. So we've both lived to tell the tale, which was nice. So
that is a great story.
Yeah. So that was 2001. I became co-manager on the strategy in 2008, and then we moved over to Polar Capital in 2010. Really, because we struggled to grow assets, within an insurance company itself. And when we joined Polar, we had about 70 million pounds or so, and today we're around 2 billion pounds worth of assets. So a good win-win. And I took on full responsibility for the fund in 2016, and we'll celebrate our 25th anniversary in October of this year, and I would have clocked up 22 of those 25 years at that point. So that was a very strange way to enter the insurance industry, but talking to many industry professionals, most people stumble into insurance rather than have it as a career choice. But hopefully over time that will correct itself, because it's certainly a fascinating industry that I've loved to be in for, as I say, well over 20 years now.
Well, that's a fascinating story. Congratulations on 25 years in business, and in the increase in assets. That's very interesting. Now, to be clear, the strategy is long only. I believe you have around 30 positions, and your focus would be on specialty insurers and reinsurance businesses. Is that correct?
Yeah, absolutely. That's correct. And we have a mandate within the strategy that we can invest broadly across the insurance industry. It's global in nature. But what we've done really is have over 90% of the assets in the property casualty industry, or over here often called the non-life insurance industry. So maybe I'll give the audience a bit of colour about that. The industry, it's not well understood, I would say, for most people, and sadly people's personal experiences with insurance companies tend to not be great. But I do think it's an industry which has some real importance. And if you look globally, the property casualty premium is about $4 trillion or so, with the US being just over half of that. And then if you look at it by class of business, roughly half is personal lines, so auto and home, and then the other half is commercial lines. And I think an important characteristic of the industry from an investment perspective is its property casualty insurance. It's not a discretionary purchase. It's something that's required by law. So just think about car insurance. You must have that. Your mortgage lender will tell you to have home insurance, and it's exactly the same for companies as well. And therefore, the buying of insurance tends to be less sensitive to the broader macroeconomic conditions. So when financial markets are a little bit more challenging and things are a little bit more difficult, the property casualty sector can be an interesting place to hide from an investment point of view. And I think for many years the industry has been considered a little bit of a GDP plus a little bit of a growth industry. But I think today I'd probably argue it's a little bit more than that, because if you think about it, what the insurers actually do is take on the risk that you and I as individuals and companies do not want. So for there to be long-term demand for insurance, you probably only have to believe that risk goes up in the world. And sadly, with climate change and wars and pandemics and supply chain disruption and deglobalization, and the list can go on and on and on, I think it would be hard to argue that risk is only going one way. And I think the other thing that's changed a little bit since maybe over the last sort of 3, 4, 5 years is that I think there's a bigger appreciation of risk in the boardrooms today than probably any time in the past. And I think that's got a lot to do with ESG. It's got a lot to do with reporting standards like TCFD, because all of that shines a bit brighter light on the risks that companies have. And those management teams and boards of directors have to demonstrate to stakeholders that they're managing those risks appropriately. And I think that gives a nice tailwind to the demand for insurance as well. And at the end of the day, your Amazon package doesn't turn up tomorrow, your ships don't sail, your planes don't fly without insurance. It's fundamental to the working of the global economy, and we like to say it's the oil that greases the wheels of world trade.
Oh, absolutely. I think people underestimate how important insurance is to the global economy. I mean, if you just look at the impact on GDP post-disaster, just due to the availability of insurance and the way insurance works. So I agree. I think there are a lot of tailwinds for this industry. Speaking specifically about running a portfolio that is focused exclusively on the insurance sector, can you talk to me about portfolio construction, how you think about commercial versus personal lines, geographic exposure, and risk management when it comes to a portfolio of stocks concentrated in the same industry?
Yeah, I think the fundamental principle of insurance is you certainly need diversification. Bad things happen in the world. That's why the insurance companies exist. And I think from an investor's point of view, probably crudely, you've got sort of a couple of options open. You can probably invest in one or two of the big insurance conglomerates. They operate in multiple countries across many lines of business, and that kind of gets your diversification. I think over time, we've generally found those kind of companies to be a bit of jack of all trades, masters of none, and the insurance industry returns in the aggregate kind of bear that out to some degree. So, roughly speaking, for our 24 years of our strategy, I think the benchmark has been up sort of 5-6% on a compounded basis, and our portfolio has done roughly double that over time. So our approach is, as you mentioned, to have these sort of 30 to 35 companies who tend to be more sort of specialists in their own field. So think of them as sort of big fishes swimming in small ponds and staying within their own underwriting sort of circle of competence. I think that's an important point to make. This is a strange industry in that you're selling this piece of paper that promises to give you some money if something bad happens in the world. So trust is a very important thing within the industry, and also you don't know your cost of goods sold when you sell that piece of paper, and therefore it does leave you a little bit open if you're a more optimist to have some problems down the line, because you might underprice your policies, but you only find that out in a few years when the claims start coming in. So it's an industry that kind of can attract some get rich quick kind of people, but actually success comes more from often playing defense and just reacting to how the underwriting markets are. And there might be times when actually the best thing to do is send off your underwriters to go and improve their golf handicaps rather than underwrite business. And the whole trick that I've found over 2 decades is actually you need to right size your balance sheet relative to the underwriting opportunity that you have. And in order to do that, you need the right kind of cultures within the company, and you certainly need management to have skin in the game. So that's a key thing for us. That sort of management, ownership, underwriting with your own money, and those businesses tend to be found in the US. And there's good examples of companies that are almost a little bit sort of like owner operator type of businesses with big family ownership. So the Markells of this world, Berkeley, Progressive. Back in the day, these are companies where managements have tens of millions, and in other cases billions of dollars worth of exposure. So they're very careful with what they do, and they're not really too concerned with building empires, planting flags, and where they are in the S&P 500 league table. They really think on a per share value creation basis, and that really is what's needed to succeed in the industry over time.
Right, long term versus short term, and managing for quarterly earnings, etc.
Yeah, and you mentioned about the sort of the personal lines versus commercial, and sort of reinsurance, is in the mix as well. I mean, generally speaking, we find personal lines insurance, particularly auto, to be a very competitive product. Highly commoditized, lowest price wins. So in most places, that's not a great recipe for investment success. We do find actually there's some markets around the world that have have a more consolidated, there where the 3 or 4 players that basically have the lion's share of the market. So Scandinavia over here in Europe was a good example of that. Canada to some extent is the same. The US is actually a pretty responsible market, and the UK is horrific, very, very challenging over time. And so for us, versus that half of the industry premium, we have about sort of 10-15% of the portfolio in personal lines. So we're very overweight commercial in insurance, and within that, the more sort of specialty side of things. So hard to place risk, hard to underwrite risks, because I think that's really where you can differentiate yourself as a company using your that underwriting skill, and that's where the sort of margins are more available. There's also less possibility of having sort of almost rogue pricing going on in some of those risks, because in a lot of cases, if you're insuring a big commercial property or a ship or a plane, it's not on the appropriate price, and therefore that sort of underpins discipline a little bit better than what you get in some of the very low premium personal lines business that I mentioned before. The other sort of thing to talk about maybe is the sort of reinsurance side, and that's a decent part of the industry. It gets disproportionate headlines, particularly when it comes to catastrophe business. Catastrophe insurance is only about $40 billion worth of premium, so probably about 1% of the industry total. So actually relatively small, but it's somewhere where people can understand because they see these horrible things that happen on their TVs, and then they see some pricing reaction to that. And I think a very important part of our process has been, we've never wanted to be a bet on whether the wind blows or the earth shakes. And I think in recent years you could start talking about heat waves and droughts and particularly wildfires as well. And I don't want to roll my investors' money and roll the dice with Mother Nature or my own. Come to think of it, I think it's important to have a limited amount of catastrophe exposure, particularly at the moment. Pricing is very strong, but just to give you a kind of sense, so for our strategy, sort of 6-7% of the look-through premiums is exposed to catastrophe risk. We have a self-imposed limit of about 10%, so we're a bit below that, but I think it's hard to argue that you want to get too involved in that line of business, particularly with everything we see almost daily on our TV screens. But I think the important point to remember is the insurance industry is a lot more than just sort of climate exposed risk. There's a lot of stuff there around liability, things like directors and officers insurance, architects and engineers. It's not just about physical things, burning down or having an issue. There's a lot of insurance that's protection against negligence and ignorance and accidents generally, and that stuff tends to be not particularly correlated with the broader economy, and again plays into this idea of how property casualty insurance can be a nice diversifier in people's portfolios.
Yeah, no, I agree with all those ideas. And, it's critical to have an edge in underwriting when it comes to insurance. Can you speak towards some of the developments that you've seen in AI or machine learning and how that may impact underwriting in the future? Who has an edge? Are you seeing anything that's really creative and different these days?
Yeah, I think it's a subject that we've thought about for quite a number of years now, and it probably even more so, obviously, given that these almost sort of exponential changes that happen around machine learning and AI more generally. And I think I was talking a bit earlier about the sort of the importance of underwriting and how that's the differentiating quality, and that really goes back to, can you as an underwriter slice and dice and understand your risk better than your competitors and price it appropriately? And through that lens, you could argue that the insurance industry were the original data companies, because that sort of underwriting edge is often based on data. Progressive would be a great example of that, how they slice and dice their risk. And for the Berkshire fans. Obviously, Geico has done similar things over multi-decades as well. So, I think that's an important thing. So, something like AI and machine learning, probably even more so. What it does is really add a superb new tool into the underwriter's toolbox. And I think the difference in the underwriting quality in the industry, which already is pretty wide, I think is probably set to widen even further, because you've got that ability to use that core resource, which is your data, and a lot of times that's claims data, which is really valuable. It's not something a startup can just go and buy off the shelf. This is sort of ingrained in companies, and it's not necessarily, I think, the biggest companies who are the winners here. It's going back to that concept before of big fishes in small ponds. If you really understand your niche, and you can actually, I think, widen your edge versus others by using these tools. And I think there's a lot of talk about will underwriters get replaced by the machines, that kind of thing. It's not something we overly expect to be the case. I think I think AI and machine learning is the phrase a lot of people use is a nice co-pilot, and just augments what it is, and all that's going to do is amplify the difference between the good and bad, probably even further.
I see. Well, when it comes to pricing risk, can you speak towards sort of the complexity of risk facing insurers, and have you seen any significant changes? And I'm thinking specifically about secondary perils. I mean, right now we have the terrible news out of Maui. In Tennessee, even this summer, we've seen some really severe thunderstorms. So can you talk about these secondary perils and any type of changes you've seen when it comes to the complexity of risk in the recent years?
Yeah, I think certainly risk is becoming ever more complex. That's just as a broad sweeping statement, but we see evidence of that everywhere. And I think you've seen probably in the news in recent months a lot of sort of Main Street insurers sort of starting to pull out of places like writing homeowners business in California or Florida or wherever, because the risk is just becoming that too complex for them. They want the law of large numbers, cookie cutter kind of underwriting, but once risk starts getting a little bit of hair on it, it tends to end up moving from the sort of admitted regulated insurance market into what's called the excess and surplus lines market, which is really, think of it as specialty type of insurance as underwritten by these specialty companies in markets like Lloyd's of London and elsewhere. And I think over recent years, roughly 10% of the US commercial business was, I think, going back sort of 5 or 6 years, written within these excess and surplus lines market. It's now closer to 20%. So that gives you an idea about how much more complicated risk is becoming. And a lot of that is to do with these the secondary perils. And I think when I started 20 odd years ago, I think the concern in the insurance company boardrooms was hurricanes and earthquakes, but now you have all these other things that are pretty closely linked to climate change. And I think if you look at the reinsurance industry results, and particularly catastrophe reinsurance in the last 5 or 6 years, they've been really, really difficult. And I think that's led to some very sharp pricing correction. And also probably more significantly, and this has really happened only in the last sort of 6-12 months, the reinsurance industry as a whole has really tried to move itself away from the underlying risk. Because what's really happened is, as these wildfires and droughts and everything has impacted, the reinsurers have really started to really picked up most of that bill. And I think the reinsurers ultimately want to be there when sort of real catastrophes happen. And these secondary perils have become so commonplace, it's almost like the reinsurers are paying the bill every year, and that got to an unsustainable place. And that's why we've seen such a severe correction in pricing in recent times. And importantly, from the reinsurer's perspective, they've moved a little bit away from that risk. And you, as the primary insurer, have then got a decision to make. You need to put up your premiums sufficiently to have an expectation of underwriting profit, or you might decide that risk has become too complex for me. I can't buy the reinsurance I want, so you start to walk away. And I think that's a situation where we're starting to see happen in certain places around the world. And ultimately, this could cause an issue because some risk might become unaffordable from an insurance buying perspective.
Mm-hmm. And Nick, what happens in those cases? So if a market is abandoned, so to say, is the solution some type of partnership between private insurance and government? I mean, what does that look like, and how? What do you think we're going to see there?
Yeah, I think that's probably the most sensible sort of route is actually sort of those kind of public-private sort of partnerships. You do see a few examples of them around in different markets where if someone can't get a policy, they go into almost a pooling system, and it gets sort of put on some of the insurers to have that to some extent. But at the end of the day, insurers they're not obliged to underwrite a risk where they're expecting to lose money. So I do think this is going to be a growing political problem over time, particularly in those more natural catastrophe exposed states. So we'll have to see how all that sort of transpires. But I think we're seeing early signs of some of that for sure.
Mm-hmm. Well, we've certainly seen an increase in pricing and reinsurance, and it's been a hard market. How long do these markets usually continue? When you look back historically at past examples of this, what should investors expect for the duration of a hard market?
Yeah, I think when it comes to cycles, I do think it's important to remember, particularly in more recent times, that I think the insurance industry is made up of lots of different cycles. It's not just one big sweeping, everything goes up or everything goes down. And I think data analytics and all of that has been incredibly helpful in sort of reducing the amplitude of cycles, so you can take corrective action on pricing a lot quicker than probably 20-30 years ago, where you don't realize quite the mistakes you've made until the claims come pouring in. I think there's a bit more of a sort of nudging pricing behavior and a bit more reacting in the industry today, which I think is supportive of more sustainable, less volatile returns for the industry over time. But that said, the cycle is always going to be there to some extent. I always think about the sort of classes of business where lots of capital coming in can change the dynamics. And that's quite hard to do in many parts of the insurance market, because you need a claims infrastructure, you need the sort of licensing, you need that back office to really be successful. But in the catastrophe reinsurance business, you arguably only need a few people sitting around a table and a big pot of money, and off you go and start rolling the dice with Mother Nature. So that's an area where you can see a bit more cyclicality. And right now, I think because we've had such poor results from most people in that market, there's a sort of fear factor that's going in, and that's leading to this very significant price rising. And how long that lasts is going to be dependent to some extent on catastrophe activity. But I do think things like sort of capital providers like pension schemes and the like, they've got fatigue. That's probably a polite way of putting it after some tougher years. And roughly 15-20% of the catastrophe market is underwritten by non-traditional capital like pension schemes, so not your traditional reinsurers. And I think that's probably going to sort of remain around that level rather than sort of go up too much more. And if you think if we're on a pension scheme board and a trustee, and someone says, reinsurance pricing has gone through the roof, this is a great time to do it, and then someone says, well, what about the all the tragic events in place XYZ, because they're everywhere on people's TV screens, and probably someone would say you were mad to be going into that, particularly in an investment environment where with bond yields going up so meaningfully. in the last sort of year or so.
Yeah.
If you can get sort of high single digits on a decent bit of corporate paper, why do you want to run the risk with Mother Nature, with climate change and all of that? You probably don't, and that keeps capital out of the industry and makes it more sustainable. So there's always things sort of going on, I think. But even if we have a year or even a couple of years maybe a very strong reinsurance results, it probably is going to take at least that time before pricing starts to be impacted. And one of the early lessons I learned when I first started at Hiscox is that price tends to go up in the lift and down the stairs. So you tend to have this sort of violent reaction on the upside, and then over time the prices start to drift down. So I'm certainly expecting a good few years of strong underwriting margins, not just in reinsurance but in primary insurance as well. And on that, we've had probably 4 or 5 years of rate increases sort of coming through. So underwriting margins are actually in a very good place right now across many parts of the industry. And I think what's interesting from an investment point of view is that suddenly, almost from nowhere, probably a bit over a year ago, suddenly those investment returns that you were earning on your cash pile and your sort of 2 to 3 year bonds, which is typically what a property casualty company has in an investment portfolio, your 1-2% yield is now 4 or 5.
I know,
and that's sort of transformational for earnings power. If you put it on, it earns through very quickly. And what that's kind of done, and we can possibly go into a bit more detail if you want, but it's taken a sort of typical ROE from a sort of low double digit to somewhere in the mid to high teens, and I would argue that the valuations of the sector have not risen commensurately with that big increase in earnings power. And I think Berkshire Hathaway is probably the exemplar in understanding the value of float, and we could maybe touch on that. And that value of float in today's world compared to a year or two ago is night and day. And I think that's a very big difference in the sector that I don't think has yet been fully understood.
Yeah, I was just talking to somebody about that this weekend, just that float has always been powerful, but now it has just exploded. I don't think the market has yet to comprehend that. We're having some technical difficulties, and I do want to apologize for that. For some reason, Scott's microphone is not working, so I'll be asking his questions for him. I'm his wife. I can do that. So his question was in regards to price-to-book multiples and whether they're reflecting that the increase in interest rates and the opportunities or the power behind the float in these businesses.
Yeah. So maybe just before get in there, just to give a bit of context as to how float works. So essentially, for an insurance company, they receive the premiums up front and then pay the claim when something bad happens. And in the interim, the insurance company can earn an investment return on that. And because the insurance company is not wanting to double up its underwriting risk, it keeps those investments very safe and solid. So a sort of 2 to 3 year sort of US Treasury kind of return is where you're kind of thinking. And an insurance company has 2 pots of money essentially within its investment portfolio. It has the capital it needs to underwrite with. So roughly speaking, for every $1 of capital you have, you can underwrite about $1 of premium. Now that number changes a little bit depending on the type of business you have, but that's a decent proxy right now. And then you have, the Warren Buffett's float as well, and what that means for our companies is that every 1% change in investment yield is worth about 2% a year on ROE or book value growth. Said another way, which is the way to really measure value creation in the property casualty industry. So if we've gone from the world of US 2-year Treasury probably up 4% or so maybe since the end of 2021, that tells you about how much increase the earnings power the companies have, and going from this sort of low double-digit level to mid to high teens, and the price to book multiples of the industry move around a little bit, but I think at the moment we can keep the numbers relatively simple. So I think for our strategy, it's about 170% or so price to book, and we would expect over the next 12 months, a sort of annual kind of book value growth in that sort of, let's call it 17% range, just to keep that nice and simple. And therefore, if you divide those numbers into each other, you have this sort of cash on cash return of about 10%. Now, over the 24 years plus of the strategy, our companies typically have grown their book value sort of 10-11% a year, and it's typically cost you as an investor sort of 130, 140 price to book. And if you do that same cash on cash calculation, you get at about 8% cash on cash return. So said another way, today you're getting a lot more for your money than you certainly have done in the last sort of quarter of a century or so, which is why I would argue that the market hasn't fully understood just how different the world is in this sort of higher bond yield environment than what we've had really since the financial crisis. So that sort of memory that's sort of been ingrained for 15 years, it's going to take a little while to come out, but I think the good thing about the property casualty sector is that investment income earns through very quickly, and we're already starting to see the impact of that, and it's just going to continue, I think. So I think there's a good prospect right now that the price to book multiple of the sector could well rise in the coming period. But I think from an investment case point of view, if you've got your book values growing mid to high teens, you could probably argue that you don't really need price to book multiples to actually go up. You'll probably be very happy as an investor if your stock return just tracked the book value growth of your company. If you look at our strategy and those sort of 10-11% type of returns, we've done about 3% better than broader markets over the 24 years, and that outperformance tends to come in more difficult times because of the defensive characteristics of the sector. So, long-winded way of saying, I think there's some bright future ahead for the industry, given where we are on margins and particularly on the power of these increased investment returns that we're seeing.
Yeah, you certainly have laid out a compelling case for the opportunities of investing in the insurance industry. There's so many aspects that you have commented on that we could go into. I think it's important to maybe speak towards inflation and how that impacts growth in premium, replacement cost, et cetera, and maybe also some comments on social inflation and what that is, how that impacts insurers. I think that's important for investors to understand.
Yeah, I think inflation is clearly a big topic for any investor in recent times, and I think one thing I would say at the start is inflation in insurance. It's probably always been there. So a large component of loss costs are medical, and as I think we all know, medical costs have only gone one way for a very, very long time. So I think the insurance industry is very used to dealing with inflation. And I think the nice thing about property casualty insurers is that most policies are on a 12-month renewal. So therefore, you can adjust your pricing to really reflect those changing conditions. Then that comment, is more skewed to probably more property insurers than on the sort of casualty and liability side. And that's really when you can come a little bit unstuck. So I think within our strategy, we tend to focus on casualty risks that are in the industry are called short tail, or medium tail. So you pay your claims within probably 2, 3, 4 years. That's why you've got that bond duration of 2 to 3 years. But many of the bigger companies that are undertaking or underwriting much more longer term risk, they have longer bond portfolios, probably 4 to 5 years, because some of those risks within those portfolios actually are expected to pay out probably 10, 20, 30 years time. So think about pharmaceutical liability, where if people taking a drug today, maybe it takes 20 years before you know whether that drug has an issue or not. And if you've got your inflation assumptions wrong when you price that risk when you're paying out in 20 years time, that is a very big compounded error. So that's a real sort of danger, and one reason why we tend to avoid some of those bigger companies, because if you're sitting on that theoretical board of directors for that pharmaceutical company, you probably want one of the big players that have been around for many decades, if not in hundreds of years, because that gives you the comfort. You don't really go for the sort of the small specialty guys that we typically invest in. So that is a sort of starting point on inflation. I think the other thing to appreciate is, as you alluded to in the question, a lot of insurance, it gets priced off of things like revenues, company payrolls, that kind of thing. So as inflation moves through the system, premium volumes naturally rise, and I think so. So not only do you get if there's inflation, of course, you get the bond yields come up. We've touched a little bit on the investment income and how big that difference is, but also on the premium volume side, you get that coming through as well, because effectively your exposure is going up. So if it suddenly costs you 25% more to rebuild your building because of inflation, you're going to have to pay more premium to reflect that. So there's a natural thing in the system that safeguards against a lot of insurance. You mentioned sort of social inflation. That's a term that's generally been used in the industry to describe sort of heightened court awards and jury awards over time. And that's something that's been with the industry now for a few years. Lots of reasons why that's occurred, but often.
Is that predominantly in the U.S. market, or is that just a global phenomena?
I think it's predominantly a US thing, but I think what starts in the US sort of creeps elsewhere over time anyway. So I think it's something that I certainly would keep an eye out for, probably anywhere. But certainly I think the US is where it's most evident for sure. And I think some of those sort of trends on inflation have been a little bit more difficult to understand than usual because of COVID. You've had courtrooms being shut, and the like. So that's kind of like muddied the waters a little bit. But certainly, underwriters, I think, being prudent when it comes to loss cost inflation assumptions, and that's really what's been driving this sort of 4 or 5 year improvement in insurance pricing. It's not that they've just got a load more money for the risk, and that they have to some extent. I think underwriting margins have gone up, but not to the extent that premium rate rises have gone up, and that's because what matters to underwriting margins is the delta between premium rate rises and loss cost inflation. Sometimes you look at sort of reports and it all focuses on rate changes, but it's very important to think about how exposure is changing, because losses come from your exposure. They don't come necessarily from your premium. There's clearly a connection between the two, but if people now are if you have an accident, they're awarding $3 million instead of $1 million 5 years ago, because everywhere on the internet you see that a billionaire doesn't really mean as much today as it might have done 20 years ago, and therefore juries award a lot more because they've trying to stick up for the smaller person. I think that creates a potential issue, and some of that stuff is what's been driving inflation. But in itself, an insurer doesn't necessarily need to be concerned about inflation as long as you expect it and as long as you price for it. It's unanticipated and unexpected inflation that can really get you. And if the time horizon between taking in the premium and the paying out of the claim is in a long period, there's more chances of you getting that wrong. So this is a difficult industry, because going back to that, you don't know your cost of goods sold. So there's a lot of assumptions that goes into pricing, and that makes it a challenging industry, and where a lot of players are not necessarily great. But if you can find those companies that can actually do well, if your competition is not that good, that actually presents you with a very interesting opportunity over time. You probably want to be competing with a lot of companies that aren't great, rather than lots of really, really good ones.
Yeah, I like the way you said earlier, and you said that a compound error over a long length of time can turn into a really big issue for these businesses. So if your inflation projections aren't correct, a small error compounded over a long length of time can create a huge problem.
Catastrophe risk for a casualty business, it's kind of implicit in a lot of companies' balance sheets, and that's, you have to be very careful in trying to understand those risks. And I think the US companies generally, you can get into the weeds a lot more when it comes to things like reserves and the like than you can in many other parts of the world. And about 70% of our strategy is actually in the US listed companies, which is so about half of the global market is US, so we're overweight US, and that's really because of that sort of understanding of the risk that within the companies. And also there's a much more in terms of capital management, how people buy back shares when the underwriting opportunity is not there. That owner mentality is a lot better in the US than we typically find in other markets around the world.
Well, speaking of other markets around the world and emerging markets, are there any opportunities there, or is that an area that you just stay away from?
Yeah, you would think there should be, because I think as emerging economies, obviously they're faster growth, and then you have this kind of a little bit this sort of S curve of demand. So as people get richer, you almost get this sort of like a wealth effect coming through, and as people start to accumulate different assets, they want to protect them through, and insurance is a great way of doing that. So you have lots of demand, certainly, but I think from an investment point of view, I think when you have the sort of relatively small investment returns overall, you have to be pretty sure about the underwriting profitability side of things. And I think as we sort of move into those more emerging markets, that becomes a bit more uncertain, because I think a lot of the players tend to be a bit more market share focused, and therefore they're more of a leveraged return on that investment side, because there's actually not really much underwriting profit to speak of. And as an investor, you want to be investing in companies where you have conviction that book values can grow at an attractive rate over time, and really you need that sustainable underwriting profits to be able to sort of make that call. And we just don't really see that in most of the emerging markets, and that's before you even get to things like can you trust the contract law and the courts and all that kind of stuff, which for a lot of insurance is very important. So we do have a bit of exposure in the portfolio, but it does tend to come from the sort of the US listed companies having more global operations. So a Chubb or a Fairfax would be an example of companies where they have a bit more of a geographic sort of spread. And then of course you get the insurance brokers themselves. They're not taking on underwriting risk on their own balance sheets. They get paid a commission or fee to place insurance risk. So for some of those bigger global brokers, the Marsh McLennans, the Aons of this world, they get some good growth in some of those emerging markets as insurance penetration rises, but they don't take on that potential balance sheet risk. They just generate some nice cash from that sort of secular growth from those in those economies.
Yeah, you just touched on one of Scott's questions, because I have them here in front of me and he's evidently on mute. I wish I could do this at our house, right? Mute him sometimes. I think he'd like to mute me most of the times. But just on the impact of deglobalization and the increased risks associated with insuring smaller markets exposed to conflict, war, fluctuating rule of law. I mean, what are your thoughts there? The impact of deglobalization.
Yeah, I think a lot of insurance is done locally, so I think so that's probably a key point. So, and I think a lot of the global brokers sort of help the big sort of the bigger companies in the S&P 500 or whatever, managing their exposures over time. Clearly, if there's more unrest in the world, You might see some of that, those production facilities, whatever else, get moving back home to some extent, and that obviously creates more insurance opportunities locally. I think that you can, certainly buy political risk type of insurance and the like, and terrorism something slightly different, but sort of political risk, where things are unstable governments and where banks might not have the certainty that they need to lend. You can actually buy some insurance to sort of cover some of that, particularly sort of development type projects, and that's quite a small part of the industry, but you tend to sort of see these kind of opportunities, and I think there is certainly sort of geopolitical risk in various parts of the insurance market, and that introduces obviously more uncertainty. So I think a lot of the time, we try and stick to the more developed markets where rule of law is very clear, contract law is very clear, there's growth opportunities anyway in those markets as risk goes up in the world, and you probably don't really need to get too involved in some of those other areas of the market. There's probably missed opportunity there's probably some great growth around that we don't find, but that growth in insurance can be a risky thing. So it's something to be very mindful of, almost growth too quickly.
So my next question for you is just in regards to, and we were talking about it a bit earlier, these secondary perils, but really climate risk. And I've heard you speak, and I've read some of your comments just on how the insurance industry can be a great partner or an important player in the ESG movement, the move towards sustainability, and this idea of, I believe you call it, or maybe it's just an industry term,
Naturebased Solutions.
Naturebased Solutions. Yep. That was the phrase I was looking for. Sorry. Nature-based solutions. Yep. And are you seeing anything creative there? I think listeners would really like to understand that aspect of this market.
For sure. I think generally as a bigger sort of point on sort of ESG and just sort of doing good for the world, just generally. I think the insurance industry has a huge role to play. And if you think of it, almost sort of crudely, we could all debate fossil fuel companies, but if those companies can't get insurance, they're going to find it very hard to finance themselves properly, and that leads to some issues for those companies. So the insurance industry has certainly got a role to play and can be very influential in how industries evolve in terms of sort of capital flows to some extent, and I think we're starting to see a little bit of that. I don't think the industry probably wants to be too sort of political in its views, and I think if companies are showing the right sort of transition plans, that they are largely going to be supported. But I think the way I kind of put it is the insurance industry has the opportunity to nudge the right behaviours. So you don't want to sort of push people into it. You just want to encourage the right things. And actually, if you as a insurance buyer are not doing what you really should be doing from a sort of ESG and sort of global citizen perspective, you're going to pay more for it in terms of your insurance premiums, and you're going to be at a disadvantage to others. So I do think the insurance industry is a force for good. And if you look at the sort of UN Sustainable Development Goals, there's 17 of them. You could probably argue insurance touches all of them. And I think that it has a very beneficial impact on society overall. And you mentioned nature-based solutions. So this is something that not only from a professional point of view, I've got a lot sort of personal interest in some of this stuff as well. And maybe the way to think of it is really the insurance industry having sort of nature as your risk prevention partner. And maybe you can illustrate that by example. So just think about, if you've got a coastal area that's exposed to potential flooding and tsunamis because of hurricane activity or the like, what are your options to protect those buildings? Well, you can build an ever higher cement concrete sea wall. No one really wants to do that. Or maybe you have a nature-based solution, sort of like mangroves or coral reefs or the like, and they act as a natural break when those sort of excessive wave activity comes in. So you're starting to see some projects, like that. So there's some good examples out there. Chubb have done something in Miami around mangroves. There's some stuff on YouTube about that, and I think we're in the early days of some of that stuff happening. But I do see companies taking a big more interest in this kind of thing. Yeah, so one of a big industry concern, and even more so in recent years, has been flooding and flood management. So and also the impact of wildfires as well. So you're seeing in some parts of the world, and certainly in California, and you're seeing a little bit of it in the UK and elsewhere. You can who can help you fight this kind of stuff? Well, actually, beavers of all things can. And there's some remarkable pictures on sort of wildfire areas in California where you've had the presence of beavers, and they've actually, the sort of surrounding forests are as good as they've ever been. And then either side of it, it's just like, the forests have been completely burnt away. And I think, it's maybe a nature-based solution example taken to, a rather an extreme, but it kind of illustrates the point. Actually, there are things out there, in nature that can really, really help the insurance industry and risk prevention just generally, and I think you'll start to see some companies doing more of that. We'd see a little bit in sort of company charitable giving and everything. There's a little bit of that, but I think nature-based solutions are becoming less of a charity sort of thing and a little bit more of the business case. And you certainly see some of that in some parts of the world as well. And institutions like the Insurance Development Forum have really been quite forceful in trying to introduce some of that into the insurance industry itself. It's not easy to do, but it's something where it makes a real difference, I think.
Gosh, it makes so much sense, and it's also such a positive story about the industry. But it can increase profitability to insurers and also accomplish some really great things for the environment. So I love that aspect of the industry, and I hope we see more of that.
Yeah,
it's very exciting. Earlier in the podcast, we talked about higher interest rates and just access to, I guess, capital, alternative sources of capital. I'm thinking about some of the movement we've seen in Insurtech over the past few years. Do you have any views on that or what we may see going forward?
Yeah, I think, when you're running a sort of sector specific sort of strategy, it's very easy as a manager, I think, probably to get caught in your own little world, in your own little goldfish bowl. And I've always been sort of, hopefully alive to that potential risk, and you don't see things coming from outside of the industry affecting what you do. And quite a few years ago now, we started getting involved, and it wasn't even called Insurtech at that point. It was an argument: is it Instech? Is it Insurtech? Is it whatever? But it's essentially the insurance version of fintech, and we got involved in a number of accelerator programs, and something called Startup Bootcamp here in the UK. We did some stuff with Accenture. We did some stuff with Lloyd's of London as a market, just to really be able to sort of look around corners. Would be the sort of phrase that I would use. And what we sort of saw like 5 or 6 years ago was sort of the cool new startups saying, we're going to come in and eat your lunch, the tired old dinosaur insurance companies. And that conversation was something that I wasn't quite sure that the companies really understood quite how difficult this industry is. People are talking about conquering America and not realizing actually America is 50 insurance markets because of it's regulated at a state level. There's things like that. But that was, those lessons were soon kind of learned. But I think the conversation changed from that, startup versus incumbent, to one of more of a partnership over time. Because at the end of the day, you need a regulated balance sheet to sell an insurance policy, and you might have the greatest tech on the front end, but you still need something on the back end. And I think what happened. And we had a few sort of Insurtech companies, sort of certainly start up. Some went to market. Some would call them, some of those companies maybe Insurrec nowadays, given what's happened to the share prices, but it's not for me to judge. It's not something that we necessarily got involved in doing that. But I think what happened was that some of the more distribution focused companies realized actually underwriting for a profit can be challenging, and actually maybe when you're trying to underwrite and you can't tie in with an industry incumbent for whatever reason, you end up having to have a balance sheet yourself, and that changes the rules of the game for a VC or other sort of capital provider who want the sort of the tech growth story. They don't want regulated balance sheet businesses, and so that's kind of like, maybe not put a nail in the coffin of Insurtech, but it certainly changed the sort of conversation to one of partnership. And I think, again, the better insurances out there are engaging with a lot of these startup companies and really augmenting what they already do. So there's definitely potential to work together. And this is a little bit, I'm going outside of my own sort of circle of competence, but it certainly seems to me to be quite different when you look at something like banking and what fintech has done to that. It's very different, at least in the property casualty world, from what I see.
Yeah. So that brings me to another question. And this one actually came in from a listener. And I'm trying to put my hands on it now, but you'll like it because it starts out with, Nick is the best. With alligator. Yeah, we always ask for listeners to write in and give us questions. And so we said that you were coming on the podcast, and this particular person wrote in and said, Nick is the best. With Allegheny off the board, which P&C players are most reminiscent of Berkshire Hathaway in terms of approach and prospects? Bonus question. In a hardened market, does he anticipate any consolidation among the remaining public reinsurance players?
Yeah, I definitely now know, but it wasn't my wife who wrote that question. So she hopefully should have started off with Nick is the best, but I'm not sure if she would have said that either. But I think, in terms of, we mentioned sort of Berkshire Hathaway, then buying Allegheny, it was near a $12 billion deal in March of last year. And I think Berkshire's biggest acquisition in the insurance and reinsurance market for over 20 years. So interesting sort of timing. But I think in Allegheny, it's arguably has been described as a bit of a baby Berkshire. It had a very sort of similar sort of strategy. Run by some people who were certainly Berkshire sort of people. And it's an interesting thought to think about. Why hasn't sort of Berkshire with its insurance driving a lot of that certainly early success really been tried to be replicated, and it's not really been done. One or two sort of on their way, I would say. And there was a interesting book by a mutual friend of ours, Larry Cunningham, and I think it's certainly been on your podcast, and he wrote a book with his wife Stephanie called Margin of Trust. And that was really looking at why it touched a lot on why the insurance industry is well suited to Berkshire, that sort of trust element, the whole element of decentralization that's very sort of important. And in that book, he sort of called out a number of companies. So the sort of the probably the more well-known ones, the Danahers, the Constellation Software of this world. But within within I think it was probably only sort of 8 to 10 companies kind of sort of named. 3 of them were from insurance, and Allegheny was one. Yeah. And then Markel and Fairfax were the other 2, and certainly people have said for both of them, but particularly Markel being a bit of a baby Berkshire. So those are sort of ones who are dead, and I think you'll be the expert on Fairfax, so I'll leave that one to you. But it's I think it's not an easy thing to do, but certainly there are others that are trying to have that model that's a little bit different from just for most of our portfolio. It's really about the importance of underwriting profit. The investments they are what they are. Is sort of whereas with some of those other companies, and there's really a handful, they take a more total return approach to investments, and then in their cases as well have some non-insurance businesses that sort of balance things up a little bit, and therefore look a little bit more like Berkshire. So that those are sort of some that are trying to do that. In terms of consolidation and the like, I think over a fair time now, reinsurers, there's been quite a lot of consolidation in that market already. What's been interesting in this sort of period of sort of more elevated catastrophes, you haven't had a wave of startups that you had after World Trade Center in 2001 and then Katrina in 2005. There was another sort of wave as well in sort of 2011 sort of time. You haven't really had that. There's one or two, but not there. So, and a lot of that's because that's sort of the days of a reinsurer having a couple of $1 billion worth of capital, I think, are behind us. You need a much more scale than that. And even, I think you've seen that a lot of the traditional insurers where they've had reinsurance businesses looking to sort of to exit that as well, because the investors don't like volatility, and reinsurance can kind of bring that. And some of this comes down to a debate. Do you prefer the Warren and Charlie's lumpy 15% or a steady 12, and that kind of thing, and many investors seem to prefer the steady returns. And you saw just recently Renaissance Re take the reinsurance business away from AIG, and there's other sort of muted sort of smaller transactions in the market, so you could see a little bit of that. But in terms of actual reinsurers being bought, they're probably of a size now where that becomes a little bit more difficult. And we've certainly never sort of, when it comes to our strategy, sort of said M&A is a reason to own the sector. I think it's a little bit of an added bonus if it happens.
Yeah, that makes sense. And I think my listeners know, or my normal listeners know, that I am on the board of Fairfax. So just out of full disclosure, I'm on the board of Fairfax. Nick and I saw each other this year at the Fairfax AGM in Toronto. We were actually at an investment conference sitting next to each other prior to the AGM. And I believe I also saw you in Omaha at the airport on the way
at the airport, yeah.
Yeah. So do you also attend Markel and all these other meetings?
Yeah, so usually the calendar is squarely focused on Omaha in sort of late April, early May, and sadly that the Markel event is only shortly after that. So being That's sort of London based, it's a bit sort of challenging to sort of to do both. But I hear some very good things about the what happens with Markel, with Fairfax, of course, sort of mid-April. In Toronto, and it's great to see the teams there. And I think it's not just about learning a bit more about those companies, and I don't need to tell you or probably your audience. It's just that the ability and just meeting other people within what you do and spending some time with people. And I think Markel were very smart to sort of understand that the kind of people who might be interested in owning Markel stock probably already own Berkshire. So many years ago they sort of started to do a brunch on the Sunday after the Berkshire meeting, which is always on a Saturday. I think it started with 8 people or something like that, and now is probably pushing a couple of thousand.
Yeah, it's on a Sunday, right? Sunday morning. Yeah. No, that brunch is great to go to, and the Markel AGM is really enjoyable. I was actually supposed to speak this year at an event prior to that that Bob Robati put on, and Scott was in the hospital, so I had to cancel. So for anybody out there who was waiting for me to show up in Richmond, I apologize. I was with him. But Nick, this has been a fascinating conversation. I could talk about this industry all day long. You're clearly an expert. I'm so happy that you are on the podcast today. Where can my listeners learn more about you, learn more about Polar Capital, if they're interested?
Yeah, I think there's a lot of information on our website, so I would probably direct you there about Polar itself and our sort of strategy. So head to the website, and I'm not too hard to find.
great. And they can always find you in Omaha in
That's
early
right.
May, right? Okay. All right. Well, thank you, Nick. Thank you for listening to Investing the Templeton Way. Please be sure to subscribe on your favorite podcast player. To view the show notes and resources mentioned in today's show, head to investingthetempletonway.com.